In this video, we're going to talk about how to record an impairment for available for sale securities. So normally with available for sale securities, unrealized gains or losses are going to go to other comprehensive income. And they're going to bypass the income statement. They're going to go directly to equity. So they're only going to affect net income when they're actually sold. So when you sell the available for sale securities, then you're going to have a realized gain or loss, and that's when it'll flow through the income statement. However, there's one important caveat. If there's been a permanent impairment, so if there's been a decline in value of the securities that is deemed to be other than temporary, this isn't just some temporary fluctuation in the stock price, the up and down movements of the stock price. Maybe there's a financial crisis. There's a financial meltdown like we had in 2008. And so it's just like, okay, this is an impairment. The stock is not going to recover its value anytime soon. So then we can write down or create an impairment, write down the value of these securities to the market value and take the loss to the income statement immediately instead of waiting until the securities are sold. So let's walk through an example. So Risky Insurance Group, they purchased $300,000 worth of available for sale securities. And so now we're going to account for them. So we've got the available for sale securities we're going to debit, and then we're going to credit cash, and the amount in each case is going to be $300,000. All right, that's pretty simple. That's just to put the securities on the books. But now something's going to happen. We're going to have a decline in the value of the securities to $280,000. So now what do we do? Well, we talked about this. We're going to book it to other comprehensive income, and then we're going to create this fair value adjustment account for available for sale securities, right? So the other comprehensive income is basically, this is the way that this decline, it went down $20,000, right? It went from $300 to $280. So it went down $20,000. Instead of that being a loss that's going to end up on the income statement, it's going to bypass the income statement, go to other comprehensive income. That's how it's going to get to equity. And then we're going to credit fair value adjustment for available for sale securities. So this is, if we went to the balance sheet, this $20,000 would reduce that $300,000 account of available for sale securities. Now you might be wondering, you might say, hey, this video is about basically booking an impairment, and you didn't do an impairment here. You just did it the old-fashioned way. Well, that's because we didn't say anything here about this decline, this decrease being permanent, right? So it's expected that securities are going to go up and down in value, right? We anticipate that that's going to happen. This goes down to 280, and then it might go up to 310. Things like that happen, right? But what we're talking about is some kind of major shift or change, something that happens and we say, wait a minute, this is a permanent decline in the value of these securities. And so let's say that that happens next, right? So the value of the securities goes to $110,000. That's a pretty big drop, right? So we were at 300 initially. We went to 280, and we weren't sure that was going to be permanent. We just thought it was normal fluctuations. But now it's went to 110. Let's say that there was a financial meltdown, and these securities were deemed to have serious problems. And so we say, you know what, we think this might be a permanent decline. It's not just some temporary fluctuation. We have to record impairment. So what we're going to do is we're going to say we're going to have a loss from the impairment, and we're going to book that loss at $190,000. I'm going to show you how I get this $190,000 right here. So we started with 300 and we went to 110. Now you might say, hey, wait a minute, but we already went down 20. I'm going to say, well, we're going to deal with that in a moment. But for right now, remember, we have not realized any losses, right? We had just had this thing go to other comprehensive income. We haven't charged anything to the income statement yet. And that's what this loss from impairment is going to do. It's taking that full 190, which is the $300,000 that we originally invested, minus the 110 that we still believe it's worth. So that $190,000 loss is going to go straight to the income statement. And then we're going to credit available for sale securities for $190,000 to reduce their value. Now, this other comprehensive income that we already went down 20, you might be wondering about that, so let's figure what happens to that. We're going to have to reverse that entry. What we're going to do, if you just take a look at this entry right here, all we're doing is the same entry as this, only it's flipped, right? So we're going to debit the fair value adjustment account for $20,000, and then credit other comprehensive income for $20,000, which is the exact opposite of what we did up here, right? So all we're doing is reversing that previous entry, because now this decline, that $20,000, that's part of the bigger decline, right? So let me just show you what would happen briefly here if we didn't reverse this entry. So let's take a look at our balance sheet. Let me make sure I got plenty of space here. So let's take a look at our balance sheet. And so we've got these available for sale securities, okay? So we start out with them at $300,000. And then we have this adjustment account of $20,000, right? So the adjustment account, although that adjustment doesn't affect earnings, right? It doesn't go to net income. It does affect how available for sale is computed on the balance sheet. But now when we have this loss from impairment, we say, you know what? We've actually, that $190,000, that's a permanent loss there. So we say, you know what? We're gonna decrease the available for sale by $190,000. But until we make this entry here, the second entry, we have not addressed this part, that $20,000. That's still there. So if we were to look and say, okay, what's the book value of these available for sale securities? It would end up being, what's that, 210, so 90. It would be 90,000. But we know that we believe that the value has declined to 110. But it would say 90 unless we reverse this 20,000 here with that fair value adjustment. So that's why we're back. That's why we're reversing this entry. Okay, when we originally put that 20,000 in, it was just like, okay, this is our temporary thing. We're going to mark these securities to market. But then when it became, okay, this is other than temporary, right? And we record this loss, then we reduce the value of the securities by the full amount, but we still had that 20,000 from before that we had to deal with. So we just reversed that entry to get rid of that. And so then the available for sale securities would be reflected on the balance sheet at $110,000, which is the proper value.